Hello, welcome to the May 2024 market update. The weather is hot and so is the market, so let's roll.
Let's go. All right, I'm Max Westerman.
I'm Victor. Josh is behind the scenes, and you know the rest of the team. You know our underlying thesis, 90% of the things you worry about never happen.
We make observations, not predictions.
The simplest explanation is usually the best.
And finally, supply and demand applies to markets as well as most products.
All right, now let's see where we are. Remember, we're only right now, as we film this, 5.5 weeks into the new year. 5.5 weeks in.
5.5 months.
5.5 months, that's right. The Dow's up 585. NASDAQ is up over 11%, and so is the S&P 500. Less than a half a year, up 5, 11, and 11.
And what's the big marker we went over yesterday, Vic?
Let me think now. That wasn't mileage on my car. Oh, 40,000. The Dow broke 40,000.
40.
I remember 10,000, 20,000, 30,000, and now we're over 40,000 on the Dow.
Next up is 50.
We're rolling. I better order the hats now.
Yeah.
So, Dow Jones Industrial Average. Here we are. You can see the chart. I don't want to point out, but I will anyway. Back in October, where you see that low, within a week of that, we said this looks like the bottom of the market. Let's start getting in. We did. Went pretty much. You see it up. We had a little pullback last month, but you see the 200-day moving average is heading up. The 50-day moving average is heading up, and the 200-day moving average up. I want to say one quick thing about the chart. You ever notice if you see someone in the hospital or you're in there, the doctor walks in, and what's the first thing, Max, the doctor picks up?
First thing I pick up is your chart.
Your chart. He looks in the chart, and in 3 to 5 seconds know what's happening. You can look at those charts, and that tells the whole story.
And it's we ask when we do this live, we ask, where is this chart trending? We ask the audience, and we say down, sideways, or up. And you can clearly see that this chart is trending up.
Yeah. Now, is the S&P doing the same thing?
The S&P and the Dow are correlating each other. What about the NASDAQ?
Yep, look at that. Look at the strength of that market. That's where we are. So, here we go. Look at the landscape we have now. And notice I've got some of the arrows. The arrows are the things that are positive for the market. If there's nothing there, that doesn't matter one way or the other, and we'll have one negative. The Fed has signaled the peak in interest rates. Historically, bull markets begin after the Fed ends their interest rate cycle.
All right, the inflation report confirms disinflationary trends in many commodities.
You're starting to see them slow down. Next, recent market advances have been moving forward because Fed Chairman Powell has made it fairly clear raises are out. It's a debate on when the next lowering is coming in.
So, the 2024 election wildcard, 64 major Democratic countries, including the U.S., have significant leadership elections in 2024, which will likely result in increased volatility.
Going to be a lot of verbiage out here. Now, the reason we pointed out election year, watch this next one. From 1928 to 2000, during election years, the Standard & Poor's was up an average 11.5%. Next, and look at this.
There have been 23 elections since the S&P 500 began. 19 of the 23 years, 83% of the time, provided positive performance.
So you're starting to see everything add up.
A lot of 83s you'll see.
Yep, a lot of 80 pluses. S&P index keeps rallying since 1970. S&P index has been positive over the next 12 months. 83% of the time.
All right, the cross current. Election year cycles set increased government spending to strengthen the economy, yet U.S. debt levels have increased quite riskily.
And now here's the only negative C. This election year, there's going to be a lot of volatility because you're going to see a lot of verbiage out there.
But just because there's volatility in the market doesn't mean it's not going to be an up market.
Correct.
As you can tell, by 83% of the time, it is an up market.
Yeah, put all those things together. You got a bull market beginning after the Fed stopped raising rates, which we've done. You got Elections going on, and 83% of the election cycles have been positive. You got the index making a new high 83% of the time. After that, they're positive. And on those elections, 19 of the 23 years, another 83%, the market's been positive. When you put this all together, I'm going to say we've got an 80% plus probability of having a continued bull market.
And Victor, do you think all of those 23 years that we had these election cycles, do you think they're all there's a lot of volatility because of the election?
In election years, there's always volatility because you've got a lot of verbiage going back and forth. So, 10 things you should know about the bull market. 1, what's a bull market? When the market has gone up at least 20% off its low.
2, apples and oranges. Though they're often similar, the stock market and the economy move in opposites of each other. The economy, the stock market, like in Jerome Powell, when Jerome Powell came out in November of last year and said we're going to have 4 interest rate cuts, the stock market went skyrocketing up. Yet we didn't even have any interest rate cuts so far. So they move. They might not move in opposites of each other.
Yep. And by the way, when he said apples and oranges, I thought we were going to have a fruit salad here, but we missed that. The bulls get bigger. Bull and bear markets and corrections are common. The S&P experienced 27 bulls, although the bulls have been stronger and longer. On average, the bull markets gained 115% over 2.5 years, while bear markets lost just 35% in 1 year.
Are we in a bull market?
Yes. Okay.
It could take weeks or months for the market to move 20% off a low. The tricky thing about a bull market is that we often don't know we're in one until after the fact. It's possible for the market to retest previous lows after rallying 20%.
You know, they tell you no one will tell you when a bull market is starting. Didn't we tell them when a bull market was
did.
starting? Okay, absolutely. And the bulls are the strongest coming out of the gate. As a matter of fact, I know you meet these crazy people. I know one of these guys that actually went to Spain and had the bulls chase him.
That's me.
Yeah. Okay, next page.
All right.
Number 6, you do that one.
Snoozing may mean losing. Since a new bull is identifiable once it's underway, you could miss many of the market's strongest days. If you wait for the right time to invest, historically, the first month of a new bull market is gained an average of 13.5%. The first 3 months of new bulls typically rise 25 to 30%.
Yep, and in bull markets come in all sizes and all sizes and shapes. I knew I could get that one. The longest lasts 12 years, and was up a whopping 580%, and the shortest lasted 25 days, but that was 1931, and that was up 27%.
Stronger today than yesterday. Overall, you drinking your milk?
Exactly. No, I protein milk.
Protein milk,
exactly.
Even better. Overall, the S&P 500 index has tended to gain an average of 114% during bull markets, but they've been getting stronger since the 70s. Of the 27 bull markets since 1928, 18 before this 1970 gained on average 78%. The 9 bull markets after have gained on average 186%.
And number 9 is very important because we see this in play right now. And they always say, oh my God, I'm afraid to buy. It's at a new high. When it went 10,000, they go, oh my God, I can't buy. It's already at a new high. They said it at 10,000, at 15, at 20, at 25, at 30, at 35. Now they're saying, you watch CNBC. Is it too late to get in? Mm-hmm. The average bear market lasts a year.
11 months.
11 months. Oh, not even a year. The average bull market?
6.5 years.
So, and we're just started. We're depending on if you want to say last October, we're 9 months into this. So don't let them psych you out. Anything that's going up, every time it continues to go up, it's a new high. So people often are reluctant to buy because it's at a new high. I want to buy things going up. All right.
So how can you make the most of a bull? Well-diversified portfolio strategy and tweaking every once in a while, and talk to a financial professional like myself, Victor, and Josh.
I would say that's exactly what we do. We're well diversified. We keep looking at it every day. We tweak a little without making major moves. And when the bull is run, you run with it. Isn't that what you did?
So you don't get trampled.
Exactly. And left behind. Okay,
So,
go.
bull markets have outlasted and outweighed bear markets. What are those giant mountains, Vic?
I think those giant mountains, those are the returns and the length of bull markets. What are those little things down underneath?
I think those are little bear markets.
Those are the little bear markets. Notice the big difference. There's a reason for that. Okay, I'll let you do this one.
All right, the S&P 500 index bull markets by the numbers. Since 1928, there have been 27 bull markets. Average gain, 115%. We'll call it. Average length, let's call it 2.5 years. Longest bull, 582%. Wow. Second longest, 400%. The first half of a bull has outperformed the second half 74% of the time by an average of 9%. The average gain during the first month of a new bull market, 13.6%. During the first 3 months, 25%. During the first 6 months, 27%.
By the way, now is no time to be shy. As you can see, they're strongest when they've started. If the average bull market lasts 6 years and we're 9 months into it, there's still plenty of room to be made.
Correct. All right, Vic, you do this one.
Okay, you know what's interesting? Yes, it goes up and down. And I want to tell you right now, we are in a bull market. Are there going, Max, you think we're going to have any corrections or pullbacks?
No.
Oh, no. Oh.
Yes, we're going to have plenty of them.
That's part of the normal process. And if you want to go back to just last year, look at last year. We had 3 big pullbacks, 3,300 points, 2,900 points, 1,000 points. If you tried to time it, you had to sell at the right time and you had to go back and buy at the right time. You would have had to make 6 correct timing decisions, which is candidly impossible. However, if you just left it alone, you earned 13.7%. It's time in the market, not
time in the market.
You got it.
And Vic, it goes back to the old saying, no pain, no gain. It goes down, there's a little pain, but then there's always more gain on the upside.
Yep, that's just how it is. Okay. All right, you do the U.S. jobs.
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 The U.S. job growth could stall in the second half of 2024 with signs of slowing labor market, according to the monthly gauge of employment trends. The Conference Board Employment Trend Index fell to a 111.25 in April from a downwardly revised 112.16
Now,
in March.
Watch this. Why is that good news? Max, a few minutes ago, said the economy and the stock market are not always the same. Sometimes they're opposite. What do we need for Fed Chairman Powell to lower rates? We need the economy to...
We need the economy to slow down.
And so that's exactly what you're seeing here. You're seeing the right ingredients in the oven to make the cake the way we want it.
That's why when you see on CNBC the reports that come out and they say, hey, we're getting more layoffs, the market tends to rally up because that is in a positive trend of getting a rate cut, which the stock market is in favor of.
Got it. What do we got next? Slow down. Same type of thesis here. We're looking for a slowdown because watch this. What is both the number one economic problem right now and the number one, I'm going to call it the political issue right now? Inflation. Everybody's concerned about inflation. If you buy groceries, you're concerned about inflation. If you put gas in your car, you're concerned about inflation. We need inflation to slow down. And that's what we're getting.
Mm-hmm.
All right.
So, I'm sure you guys have all heard about artificial intelligence. How are we using it here? Vic?
By the way, one of the things is, here's the real deal. Artificial intelligence has come into the world, and it's going to be a game changer in many different things. And it really boils down to this. You cannot work with it and get left behind, or you try to adapt and improvise and work for it. We've adapted it. We're working with it. We now, for example, have an artificial intelligence program, a tax scanning program. You send us your tax returns. The program scans it, and we find all the weak or missed points in there. We also find out where you're very close to being in the next level, moving your tax bracket up. If you're in retirement, it makes a very big issue of timing of, do I take the money out of my retirement account? Do I take it out of my regular account? Do I take it out of, what else would I take it out of?
Retirement.
Okay.
Annuity?
Yeah, that was what I was looking for. The annuity account. We can help with the timing to make sure that your withdrawals are the most tax efficient manner possible.
So those who fail to learn from history are doomed to repeat it.
That says Winston Churchill. I thought I said that. Here's why we got this. I want you to pay special attention to this editorial, because when you read it and then understand its context, it's so important. Watch this. It's a gloomy moment in history. Not in the lifetime of any man who reads this paper has there been so much grave and deep apprehension. Never has the future seemed so dark and incalculable. The domestic economic situation is in chaos. Prices are so high as to be utterly impossible. The political conundrum severs and bubbles with uncertainty. The United States is beset with racial, industrial, and commercial chaos, drifting we know not where. And Russia hangs like a storm cloud on the horizon of Europe, dark and silent. It is a solemn moment, and no man can feel indifference. Of our own troubles, no man can see the end. That describes exactly where we are today. However, Max, when was that editorial?
That editorial was in 1854.
Harper's Magazine, October the 10th, 1854. Times change, but people don't. Those who fail to learn from history are doomed to repeat it. Those who do learn from history can prosper from it. And that sort of brings it all together. One of the biggest things we do is...
We are psychiatrists.
Well, yeah, we bring in
we tie it all together, and we bring in the historical context. Why? Because like Victor just said, times change, but human nature doesn't.
And you got to realize this: when you're watching the media, when you're watching CNBC, what is their time horizon?
That day?
That day, 5 o'clock that afternoon. When you watch CNBC, they have an announcement coming. They'll have a clock down in the corner. It's 3 hours and 20 minutes. It's 2 hours. Their time horizon is that day. They don't look long term. They don't look medium term. They don't even look short term. They look day term.
Because what's their objective, Victor?
Their objective is not to make you a better investor. Their objective is to get you to watch. In the same way that weathermen love a hurricane because more people watch, the media loves to have some storm, something
big event.
A big event to make you watch. And fear sells better than greed. So, don't worry about what the media is saying. You've got to take a historical perspective to be successful. Okay.
All right. Why? Because the pattern has repeated itself since 1926. Talked about this before.
Yep.
Bear markets are on average 11 months, while bull markets are 6.5 years.
So I got 1 year to almost 6.5.
Yeah. It's time in the market, not
timing the market.
Exactly.
Absolutely.
All right. So thank you for joining us today.
We're trying to give you a brief update every month. And remember, these do not replace personal calls. If you'd like to talk to us, please do. But we get these out so you can get the information quick, conveniently, and if you've got any issues, please give us a call. Because remember,
we're here
looking out for you.